Volume is a crucial component of market analysis. It represents the number of shares or contracts traded during a specific time period. Why does volume matter in trading? Volume confirms price movements, shows market participation levels, indicates conviction strength, and helps identify potential market reversals. High volume during price increases suggests strong buying interest. Notice how increasing volume confirms the uptrend, showing conviction behind the price movement. High volume during price decreases indicates strong selling pressure. The heavy volume shows that many market participants are selling, validating the downtrend. When volume is low, it may suggest uncertainty or lack of interest from market participants. Price movements on low volume are often considered less significant and potentially unsustainable. Traders should be cautious about such movements as they may indicate a potential reversal or consolidation phase. How can traders use volume to make better trading decisions? First, always validate price breakouts with volume confirmation. Be cautious of price movements that aren't supported by adequate volume. Look for volume divergence as a potential reversal signal. Use volume to gauge overall market sentiment and participation levels, and combine volume analysis with price action for more reliable trading signals. The accumulation distribution line, or AD line, is a volume-based indicator that measures money flow into and out of a security. At its core is the close location value, or CLV, which analyzes where a price closes within its trading range. The CLV ranges from -1 to +1. When price closes near the high of the range, CLV is positive, indicating accumulation. When price closes in the middle of the range, CLV is near zero, indicating neutral money flow. And when price closes near the low of the range, CLV is negative, indicating distribution or selling pressure. The AD line is calculated by multiplying each period's CLV by its volume, then adding this to the previous AD line value. Let's visualize how the AD line relates to price action. This chart shows price movement in the top panel and the AD line in the bottom panel. When the AD line rises, it indicates accumulation, suggesting buyers are more aggressive, closing prices near the highs of their ranges. When the AD line falls, it indicates distribution, suggesting sellers are more aggressive, pushing closing prices toward the lows of their ranges. One of the most valuable signals from the AD line is divergence. Here we see a bullish divergence where price falls, but the AD line doesn't fall as much, suggesting underlying buying pressure despite lower prices. To summarize, the AD line helps identify underlying buying or selling pressure. Rising AD lines indicate accumulation and buying pressure, which is bullish. Divergences between price and the AD line can signal potential reversals. Bullish divergence occurs when price makes lower lows, but the AD line doesn't, while bearish divergence happens when price makes higher highs, but the AD line doesn't confirm. The Chaikin money flow, or CMF, was developed by trading analyst Mark Chaikin. The Chaikin money flow measures the money flow volume over a specific period, typically 21 days. CMF oscillates above and below zero. Positive values indicate buying pressure, while negative values indicate selling pressure. Values above positive 0.1 suggest strong buying pressure, while values below negative 0.1 indicate strong selling pressure. The area between these thresholds is considered more neutral. The Chaikin money flow calculation involves three main steps. First, the money flow multiplier is calculated based on the relationship between closing price and the high-low range. Next, this multiplier is applied to volume to get money flow volume. Finally, the CMF is calculated by dividing the sum of money flow volume by the sum of volume over the specified period. In practice, traders analyze CMF alongside price movement. When CMF is above the positive 0.1 threshold during an uptrend, it confirms accumulation and buying pressure. Conversely, CMF readings below negative 0.1 during a downtrend confirm distribution and selling pressure. Key takeaways from the Chaikin money flow indicator. CMF measures money flow volume over a specific period. Values above positive 0.1 indicate strong buying pressure. Values below negative 0.1 signal strong selling pressure. CMF helps identify the dominant market force, and it's most effective when used alongside price action for confirmation. The Money Flow Index, or MFI, is a powerful oscillator that combines both price and volume data to measure buying and selling pressure in the market. Often referred to as the volume-weighted RSI, the MFI creates an oscillator that ranges from 0 to 100, giving traders insight into the flow of money into and out of a security over a specified time period. Calculating the MFI involves several steps. First, we determine the typical price by averaging the high, low, and close. Then we calculate the raw money flow by multiplying typical price by volume. Finally, we compare positive and negative money flows to create the money flow ratio, which is converted to the MFI value. Interpreting the MFI follows similar principles to other oscillators. The scale ranges from 0 to 100, with specific zones indicating different market conditions. Readings above 80 are considered overbought conditions, suggesting a security may be due for a price correction. Readings below 20 indicate oversold conditions, potentially signaling a buying opportunity. When analyzing a chart, traders look for relationships between price action, volume, and the MFI indicator. Let's observe how these three elements work together. The money flow index appears below the price and volume charts. Note the overbought threshold at 80 and oversold threshold at 20. When MFI reaches these extreme levels, it often indicates potential reversals. One of the most powerful signals in MFI analysis is divergence. Here we can see that while price is making a lower low, the MFI is creating a higher low. This bullish divergence suggests the downward momentum is weakening and can signal a potential reversal. The MFI excels at identifying potential exhaustion moves and price extremes, making it a valuable addition to any trader's toolkit when analyzed alongside price action and other indicators. Volume-weighted average price, or VWAP, calculates the average price a security has traded at throughout the day, weighted by trading volume. The formula takes the sum of price multiplied by volume for each period, then divides by the total volume. This gives more weight to price movements with higher trading volume. Let's visualize how VWAP works on a price chart. The gold line represents the VWAP, while the white line shows the price movement. How do we interpret the relationship between price and VWAP? When price moves above VWAP, it indicates bullish sentiment in the market. Conversely, when price trades below VWAP, it suggests bearish sentiment, indicating selling pressure is dominating. Institutional traders heavily rely on VWAP to determine optimal entry and exit points for large positions. It serves as a crucial benchmark for execution quality. An important characteristic of VWAP is that it resets at the beginning of each trading day. This makes it primarily an intraday indicator. VWAP serves as an essential benchmark for traders, helping them assess whether they're getting good execution prices relative to the day's average trading activity. By comparing your execution price to VWAP, You can determine if you're trading at favorable levels compared to the average market participant. The Negative Volume Index, or NVI, is a specialized volume indicator that focuses exclusively on days when volume decreases compared to the previous trading day. Let's examine how NVI is calculated. On days when volume decreases, the NVI increases if the price rises, and it decreases if the price falls. However, if today's volume is equal to or greater than yesterday's, the NVI value remains unchanged from the previous day. Let's visualize how the Negative Volume Index works with a price chart. The blue bars represent volume, with red bars indicating days when volume decreased compared to the previous day. The NVI only changes on days when volume decreases, shown here in red. When the price rises on lower volume, the NVI increases. When the price falls on lower volume, the NVI decreases. Notice how the NVI responds to price movements specifically on lower volume days. These are highlighted points where significant NVI changes occurred. The theory behind the Negative Volume Index is based on the concept of smart money versus uninformed investors. On high volume days, the market is thought to be dominated by uninformed retail investors. In contrast, on lower volume days, informed professional investors or smart money are believed to be the primary market participants. The NVI aims to track the activity of these professionals by focusing exclusively on lower volume days. When interpreting the Negative Volume Index, traders look for divergences between the NVI and price. A rising NVI is considered a bullish signal, suggesting that informed investors are accumulating positions. Conversely, a falling NVI can be interpreted as a bearish signal, indicating that informed investors are reducing positions. Since the NVI only changes on lower volume days, it helps filter out market noise from uninformed trading activity. To summarize what we've learned about the Negative Volume Index, it focuses exclusively on days with decreased volume, based on the theory that informed investors operate primarily on lower volume days. A rising NVI often precedes upward price movements, making it useful for filtering out market noise and identifying potential trends ahead of time. The Positive Volume Index, or PVI, is the counterpart to the Negative Volume Index. Unlike NVI, the PVI focuses specifically on days when volume increases compared to the previous day. The calculation of PVI follows specific rules based on volume changes. When today's volume is greater than yesterday's volume, the PVI adjusts based on price changes. However, if today's volume is less than or equal to yesterday's volume, the PVI remains unchanged. Let's visualize how the PVI responds to changes in price and volume. The green and red bars represent trading volume. Notice how the PVI line changes primarily on days with increased volume. Let's understand how to interpret the Positive Volume Index. When higher volume occurs with rising prices, PVI increases, indicating buying pressure from the public. Conversely, when higher volume coincides with falling prices, PVI decreases, suggesting selling pressure. PVI is especially valuable because it tracks the activity of public or uninformed investors, who are believed to be more active on higher volume days. By monitoring PVI, traders can better understand crowd behavior in the market. This insight can help identify potential market turning points, as excessive public participation often signals market extremes. The Klinger Volume Oscillator, or KVO, was developed by Stephen Klinger as a tool to measure the long-term flow of money into and out of a security. The KVO combines price and volume data to provide insights into the flow of money. Let's first look at a typical price chart with volume. Let's understand how the KVO is calculated. It uses volume force, which combines volume, trend direction, and price range. The KVO itself is the difference between two exponential moving averages of this volume force, typically a 34-period and 55-period EMA. Additionally, a signal line is created using a 13-period EMA of the KVO value. Now let's see how the KVO appears when plotted below a price chart and how it helps identify trading opportunities. Trading signals occur when the KVO line crosses above or below the signal line. Crossovers above the signal line are bullish, while crossovers below are bearish. One of the most powerful aspects of the KVO is its ability to identify divergences between price action and volume flow. Here we see a bearish divergence where price makes a higher high, but the KVO makes a lower high. To summarize, the Klinger volume oscillator combines price and volume to track long-term money flow. It generates trading signals through crossovers with its signal line and can identify divergences that potentially signal trend reversals. The KVO tends to be most effective in trending markets. The force index is a powerful technical indicator created by Dr. Alexander Elder. It combines price movements with volume to measure the strength or force behind market moves. The force index is calculated by multiplying the volume by the difference between the current closing price and the previous closing price. Let's visualize how the force index relates to price and volume movements in a chart. As we can see, the price fluctuates over time. Now let's add the volume component. When we calculate the force index, we multiply the volume by the change in price from the previous period. Traders often use the force index in both its raw form and smoothed with a moving average. The raw force index can be quite volatile, showing significant spikes on days with large price movements and high volume. Applying a simple 3-period exponential moving average smooths out the indicator, making it easier to identify meaningful signals while filtering out noise. The force index offers several valuable applications for traders. First, it confirms trends when the force index moves in the same direction as price. Positive readings in uptrends and negative readings in downtrends suggest trend continuation. Second, divergence between price and force index can signal potential reversals. When price makes new highs but force index doesn't confirm, it indicates weakening momentum. Third, the force index helps evaluate breakout strength. High force index values during breakouts suggest strong conviction, while low values may indicate false signals. Finally, extreme force index readings after extended trends can signal potential exhaustion points, warning of possible trend reversals. Let's look at some practical examples of how to use the force index in trading scenarios. In a bullish scenario, look for price breaking above resistance with the force index turning positive on increasing volume. The force index should remain positive during pullbacks, confirming the uptrend's strength. In a bearish scenario, watch for price breaking below support with the force index turning negative on increasing volume. The force index staying negative during rebounds confirms the downtrend's strength. Volume-weighted MACD enhances the traditional moving average convergence-divergence indicator by incorporating volume into its calculation. To understand VMACD, let's first review the components of the standard MACD. The traditional MACD formula subtracts the 26-period exponential moving average from the 12-period exponential moving average. Volume-weighted MACD modifies this approach to add volume as a weighting factor. Let's compare standard MACD with volume-weighted MACD to see how volume affects signal reliability. Here we have a price chart with increasing momentum and several pullbacks. Notice the volume bars below the price action. The standard MACD appears below on the left side. It calculates momentum using only price data. The volume-weighted MACD on the right incorporates volume into its calculation. Notice how it responds more dramatically to price moves with high volume. Let's examine the trading signals generated by both indicators. Green circles represent bullish signals, while red circles indicate bearish signals. Volume-weighted MACD offers several key benefits compared to standard MACD. When trading with volume-weighted MACD, look for these signal patterns to identify high-probability trading opportunities. Ease of movement, or EMV, is a volume-based indicator developed by Richard Arms. It measures the relationship between price changes and volume, showing how easily a price can move in either direction. The EMV formula calculates the ease of price movement by dividing the distance moved by volume. Distance is measured as the change in the midpoint of today's high and low compared to yesterday's values. Volume is typically scaled down to make the indicator more readable. Let's look at how EMV relates to price movement on a chart. The EMV indicator is plotted below the price chart with a zero line representing neutral movement. Interpreting EMV is straightforward. When EMV is positive, it suggests prices are advancing with relatively low volume. Negative EMV values indicate the price is declining with low volume, suggesting easy downward movement. Traders often look for EMV crosses above or below the zero line, which may signal potential changes in trend direction or momentum. In summary, EMV helps traders identify whether prices are moving with or against the path of least resistance, potentially signaling continuation or reversal patterns. Volume by price displays trading activity at different price levels, showing where the most significant buying and selling has occurred. Let's begin with a standard price chart showing price movement over time. Traditional volume analysis shows volume bars at the bottom of the chart, indicating trading activity at specific time periods. Volume by price shifts our perspective from time-based to price-based analysis, displaying volume horizontally at different price levels. Notice how certain price levels have significantly higher volume than others. These high-volume zones typically act as important support or resistance levels. Let's examine the key characteristics of volume by price and how traders use this information. Traders use volume by price to identify potential entry and exit points. When price approaches a high volume level, look for bounces or breakouts to signal trading opportunities.